Hey everybody, this is Pat Jennings again from thebizseller.com, talking to you about the 10 things you need to know today if you want to sell your business tomorrow. These are the fundamental truths about selling your small business that are not talked about anywhere else. This is not a series of how-to videos, how to recast your financial statements, how to write a business for sale ad, how to write a selling memorandum. These are bigger, fundamental ideas and facts and truths about what will determine the price you can sell your business for, and in fact, even if you can sell your business. And in this video, we're going to talk about the fifth thing that you need to know, the fifth concept you need to understand if you want to sell your business, and that is that you need to understand how and why the type of buyer your business attracts will determine the price that you can possibly sell your business for. Now, just as a review, this whole series and the book by the same name is about a specific type of business. It's what we call the 120 business, which is businesses that do $1 million in sales or less, although it might be a little more, 20 employees or less, although you might have 21 or 22. But the main feature of these businesses is that they are owner-operated businesses that serve a local area, and specifically we're talking about in this series how these businesses are different from every other kind of business when it comes to selling the business. These 120 businesses are in their own category when it comes to selling the business. They're valued in a different way. The pool of prospects are completely different than other small businesses. The competition level is much higher, and the way that the sale of these businesses takes place, or financed, the way these businesses are financed, it's completely different than what you see in most of the media. When even small business publications like Inc. magazine and Entrepreneur magazine, of course Forbes, and just in general small business sites, when they talk about selling a business, when you get down to it, when you look at the facts that they convey, they're really talking about $5, $10, $20 million businesses, and not the majority of truly small businesses, which typically have $1 million or less and 20 employees or less and are owner operated. And so if that's the type of business you have, then you're the type of business owner I'm talking to. Now, thing number 5 you need to understand if you want to sell your business is that different types of businesses attract different types of buyers, and the type of buyer your business attracts is going to determine the size of the multiple that you can charge and the price that you can get for your business and the terms that you can demand for that sale. So there are 4 different types of buyers or categories of buyers: professional buyers, industrial buyers, strategic buyers, and for 120 businesses, the buyers are individuals. An individual, a partnership, a couple owns the business, and they're going to sell it to someone who is just like them 99% of the time. So let's go through these one at a time so you can understand why certain businesses sell for certain amounts of money and other businesses are on a completely different scale. Now, first we have the professional investors. These are venture capitalists, private equity groups. They may have an intermediary approach them about an investment opportunity that's currently on the market, but mostly they proactively seek out companies in a specific niche or industry that they know well. They target companies that they believe have good management in place and that have the potential for fast growth if they just got an investment from one of these professional investors. Since the professional investor is experienced in buying similar companies, they already have a formula to value and price a business, and they apply that formula, and if the formula works out, they pursue a deal, and if it doesn't, it doesn't. They don't. They know exactly what they're looking for. They know what they can afford to pay based on their real-world experience, and they know specifically how they are going to grow the business if they buy it by adding their capital and their marketing know-how and whatever other advantages they bring. These professional buyers are investors, though they're not managers. They will value your business based on the assumption that you are going to stick around to run things once they inject the operation with their cash. So if you're looking to retire, this is not the kind of buyer that you want to look for. Now, the industrial buyer or industry buyer These are different from the professionals in that while the professional investor is probably interested in a few different industries, the industry buyer is targeting companies that are exactly like them or complementary to them and to the businesses that they already own. Unlike the professional investor, the industry buyer doesn't care that much about upper management within the company that they're buying. They already have their own management team in place. And what they're going to do is they're going to buy similar companies, oftentimes in other regions, that allow them to expand geographically. The other benefit that they might be pursuing is that of economies of scale. In a sense, they're buying new customers. They're buying additional customers. And by acquiring many new customers at once, a business can ramp up production, buy raw materials in larger quantities, and thereby lower their per unit costs. They can lower overhead by eliminating redundancies. For example, they will likely eliminate or shrink the managerial staff of the company they bought because they already have their managers in place. All this means that the same number of customers buying the same amount of product can lead to better profits because they're going to sell the same types of products to the same types of customers after they bought the business. But now they're going to do it more efficiently on a larger scale, so it's going to be more profitable. And this demonstrates a very important point. Premium multiples and extremely high selling prices, these prices don't just fall from the sky. There are logical reasons behind every premium multiple that you hear about. There are logical reasons behind every spectacular selling price that you hear about for a particular type of business. There's going to be faster growth, economies of scale, reduced overhead. All those things provide incentives for the buyer to pay a premium for any business that can help the buyer achieve those sorts of outcomes. It's not uncommon for an acquiring company to be 5, 10, even 20 times bigger. And I'm talking now specifically about industry buyers, businesses that are buying up similar types of businesses. Usually they're not a little bit bigger, they're usually much bigger than the companies they buy. So if you're approached by a competitor or you're thinking of approaching a competitor to see if they might want to buy you, that usually doesn't work. You can't expect your peers, somebody with the business that's the same size as yours, to really offer you a knock your socks off type of price. In fact, it's a good idea to consider your direct competitors and your peers as the buyer of last resort. Instead of plan B, they should be plan Z. If you're approached by one of your peers, it's usually the case that they just want to see if you'll bite on a low ball offer. Or worse, they may just be trying to get in and see the inner workings, the secrets of how your business operates. But regardless of their motivation, they usually won't have the financial resources to make you an above average offer or even an average offer. Think about this. Let's say your business is worth an estimated $500,000. Let's say you got a similar competitor across town or across the state. They're also worth about $500,000. Well, where are they going to get the $500,000 to pay you for your business? They're going to have to sell their business. That's the only resource that they have. They don't have the money to buy a similar size business. So usually the idea of selling to a similar size competitor, particularly with smaller businesses, you hear a lot about it, it usually doesn't work. Next, we have strategic buyers. And this is the category of buyer. These are the kinds of deals that get all the media attention. Strategic buyers are looking to acquire assets that only the target company can offer. Specific technologies, specific patents, proprietary content, things the acquiring company can't easily go out and create for themselves. So these are rare but newsworthy deals. Google makes news all the time buying up smaller, sometimes unknown companies for millions or billions of dollars. YouTube is probably the most famous example. The money they paid YouTube was based on what YouTube could become once it became part of the Google family, not based on the profits it already produced. That's a rare circumstance, but it's also the kind of circumstance, the kind of deal that dominates the news. So, like we said, Great deals don't fall from the sky. If there's a premium multiple involved in a deal, if there's a premium price, there's a reason. There are patented products, there's proprietary content, software, economies of scale, experienced management and operating systems in place that will allow the acquirer to, with their cash, to really grow that business disproportionately fast. So the potential for quick, dramatic expansion and profits. The bottom line is, all of these buyers, when they come in and buy a business, they transform that business, making it different and more valuable than it was. And if the owners just kept running things the way they were, things are going to happen much slower. But when you get a strategic buyer or a bigger industrial buyer to buy you, you're now a different company, and that's why they will pay a premium to buy you. All three of these buyer types have certain things in common. One is that they're looking for very specific types of businesses that meet a very specific set of criteria. They may look at dozens, hundreds, 1,000 businesses, 1,000 candidates to make one acquisition. And you're not going to hear about the thousands of deals they walked away from or didn't make. In fact, you rarely hear about the ones they do make, just the really expensive ones, just the ones with the wow factor. Last year, Facebook bought something called WhatsApp for $19 billion. And for several weeks, it was the most talked about business story among outlets that cover business, big or small business. A month later, Google bought something called Oculus VR for $2 billion. That $2 billion deal barely made a ripple in the media. So the media provides a distorted view of how business sales and business acquisitions work. But basically, it's patented products, proprietary software, economies of scale, experienced managers and operating systems that are in place that make a company an attractive target. And when an acquirer identifies one of those businesses with great potential, they are very motivated to buy. And in fact, that's one of the things that lead to premium multiples. The buyer is more motivated to buy than the seller is to sell. Usually, the seller isn't looking to sell until the buyer comes to them and makes an offer. And that's completely the opposite of what we see with smaller owner-operated businesses. If we look at the majority, 96, 97% of all small businesses with employees, the 120s, there's rarely a patent or proprietary information involved. Restaurants would be the exception because of recipes, but then every restaurant has their own recipes, so that doesn't distinguish them from other restaurants. The new owner is the management team. Instead of buying up a company that already has great management in place, one individual is going to sell the business to another individual, and that new individual is going to be the management team. And usually the buyer is a first-time buyer. They're new to that business, so they're not going to improve the management, and they're not going to have any abilities to exploit economies of scale or geographic expansion because it's one individual selling to another individual. And usually the individual buyer goes out and looks for businesses that are already advertised for sale. And so the seller is already motivated to sell, more so than the buyer is to buy. The buyer always has the option to do nothing. On an individual basis, the buyer always has the option to do nothing. So these 120 businesses are owned by individuals, they're going to be bought by individuals and run the same way. And that's why we say that businesses of this size, unlike with the other situations, these businesses must be valued based on their proven historical profits. The business is going to be operated in much the same way that it's always been operated, even after it's sold. In other words, the new owner is going to run the same race that the old owner ran. They're going to sell the same products in the same market to the same customers for the same price, at least up front, and the same economic conditions, at least at the beginning, that the old owner was working in. And in fact, a new, less experienced owner will do well in the first year to maintain sales, never mind drastically increase them. And it is rarely the case that the owner of a local gift shop or sandwich shop or landscaping business is going to be pursued by a bigger operation that wants to buy up smaller businesses as part of their expansion plan. In fact, large companies that deal in these local service and retail businesses have a way of expanding, and that's through franchising. They don't buy up existing local operators. In fact, what they is competition, because they want to expand. They want to open up new locations by selling those locations to the same sort of individual buyer that you, as an individual owner, are trying to find. The prospects are the exact same for you and McDonald's and UPS and Subway. So most small businesses are truly small businesses. So when it goes to sell that business, there's a lot of competition. There's always a lot of businesses for sale. And the phenomenon of franchising has just increased the amount of competition that sellers have to deal with in finding buyers. In the book, 10 Things You Need to Know Today If You Want to Sell Your Business Tomorrow, we go into detail about how this misunderstanding, particularly in the media, about how different sized companies are valued. They're valued on different scales. And that misunderstanding is the biggest single source of frustration and misunderstanding among business sellers. And it's not an overstatement. Every survey on the topic that I'm aware of shows that the number one reason that small businesses fail to sell is unrealistic price expectations on the part of the seller and on the buyer. Buyers have a lot of unrealistic expectations too. A lot of them have heard through the media, you can buy a business for nothing down. So a lot of them come into the game with unrealistic expectations. And the fact is that the number one thing creating these unrealistic expectations is that these small businesses, what I call the 120s, don't get any coverage in the media. Most people who write about small businesses are generalists. They're unaware of the very real differences between the small business with $100,000 or $1 million in sales as compared to the one with $10 or $20 million in sales. Because the people who cover small business write about everything that has to do with small business, not just the selling of the business. The distinctions I've laid out in this video and in the chapter in the book are completely unknown to most journalists. And so that's why the next thing that we're going to talk about is thing 6. When the media writes about small business, they're not writing about 120 businesses. They're writing about 20 million and $50 million businesses. And they have no idea what they're talking about when it comes to selling a smaller owner-operated business. The bottom line is that 120s are a unique category of small business. The way they're valued is unique from bigger businesses. That's never discussed in our media. And what we're going to do in this next video is go through how this phenomenon works so that when you're out there on the internet doing research, preparing to sell your business, we're going to go over how you can tell if something you're reading applies to you or if it's written for someone with a business that's 10 or 100 times bigger than your business that just happens to be considered small business as well. So that will be in the next video. In the meantime, if you'd like, you can download the book, 10 Things You Need to Know Today If You Want to Sell Your Business Tomorrow, by going down to the description section, and at the very beginning there's a link to thebizseller.com. You can go there and download the book for free. In fact, it's so free we don't even ask for your email address. And so you can do that now, or I will see you in the next video.